warm welcome to Ada and Yanfor, two lending protocols that are here. We're just waiting for Meld as well. And thank you for making the time to appear on this space. Also, Regan, my co-host from Cardano Times, for co-hosting the space with us. The aim of this space really is to become familiar with the lending platforms on Cardano and understand their services, how they're shaping the DeFi ecosystem, and all the exciting things they're adding really to this space. The space itself is divided into two main segments. So we're going to be going through sort of various types of questions with the projects themselves. That's the main chunk. And then we've got the Q&A from the audience at the end. And the good news is Yanfor has been generous enough to offer about 10,000 of their CBLP tokens. And that's going to be going to the best question that is aired within the space. So the discussion, guys, is really meant to be like a free-flow discussion. So any project that wants to add to the points, of another, just please put your hands up if they're talking. We'll come to you next on that area. We hope to obviously keep the whole thing under an hour, but let's see, and we'll just go with the flow. Also, speakers from the audience, please just limit yourselves to one question, and that gives a chance to anyone else who wants to obviously ask any questions. That would be great if you could do that. And without really further to do, let's get started with introductions of the projects. And let's start off with Ada. I think you were here first, so please introduce your project itself, and we'll kickstart it, and we'll go to Yanfor next.
Okay, so I am Mantas. I am the founder of ADA Finance. We are, as all of us, are the lending protocol, and we have already launched our app on Cardano mainnet, and you can actually make the loans there already. So that's what we are. I think what's worth mentioning is that we are peer-to-peer platform so far. So it's something what ETHLend was in 2018. When there was two-sided marketplace where lender have to find borrower and borrower have to find the lender. This is our current version. It's not the end one. We are working on the V2 as we call it, which one will be more liquid.
That's great. Thank you very much for that, Mantas. And Yanfor. So is it Brandon you want to go for it, or we got one of your devs on board as well?
Oh, lovely. Yeah, sure. I just saw he just joined. Hey guys. So my real name is Brandon. I'm the founder of Yanfor. And Yanfor, just to sort of sum it up really quickly, because it is rather different from the norm. It's a decentralized non-custodial lending protocol, and we're building it on Cardano. Yanfor is what we're sort of coining the first community-backed lending protocol. And so we've taken the sort of like angle of actually taking the borrower's interest at first. So the benefits of Yanfor are just there's no liquidation risk, there's no margin calls, there's no interest repayments, and indefinite loan terms. Yanfor is able to do all of this really summarized really quickly because it's fundamentally investing alongside the borrower in ADA. So it's fundamentally investing in ADA, but just giving a larger share of the profits at the end of the loan term to the borrower. Yanfor also has an associated CBLP token as well that comes with it, and that sort of acts more as a sort of stopgap, if you will, sort of determining based off supply and demand the lending rates, if you will, for a particular sort of market and time and place. That's sort of gist of it. Yanfor is rather, we've taken a very novel approach, and this is just because of the power of Cardano and the Ouroboros consensus mechanism. So we're able to have liquid staking. So the depositor, the borrower, all he has to pay off their, essentially in quotation marks, pay off their loan positions by just having the collateral reach a certain amount and just the passive staking rewards. And we're aiming for a very sort of passive set and forget sort of loan experience with Yanfor. So I hope that sort of made sense, but if anyone's really interested, the live paper sort of sums it up right. I'm not the most articulate when I'm sort of talking about it from a overall summary standpoint, but yeah.
No, that sounds great. Thank you for that. And we'll also introduce our co-host, if you want to do that, Regan, please.
Hey guys, my name is Reagan. I run Cardano Times and just like getting to know the spaces. Have done a few interviews on spaces before, and I mean, I would really like to just get to know some of these projects, some of the people behind Cardano, what we're working on, and just kind of add some additional information. We're going to cover various questions today, and we're really just going to dive into y'all's projects. Anything that's unclear, we're going to probe in there a little bit and make sure that ourselves and the audience both have a clear understanding as to probably like some of the risks that are involved, also how you're protecting your customers and the clients, because at the end of the day, we all understand that this is a really possibly risky risky space. But if things are done correctly, then I think it has potentially extremely high upsides. So I think that's why we're all here as well. But hopefully this space adds some clarity to the lending platforms that are coming online, and I really look forward to it.
Fantastic. Totally agree with you, Reagan, there. I mean, we're still a very much sort of early stage, if you like, L1 that's building, and it's moving very rapidly. We all know the merits of obviously Cardano, and I think that's where I want to really start. And this question is to our projects here. How do protocols contribute to the Cardano ecosystem? But also, does Cardano offer any particular advantage over any other layer ones for lending platforms? We'll start off with Yam4 here because we started, I think, second. So let's go there, and we'll come to Mantis from Arda next.
So I would say lending is just one of the back pillars of just decentralized finance, and just even if you look in the traditional sort of sector, lending and borrowing just make up such a substantial substantial amount. It's one of the pillars. Obviously, you need to incorporate stablecoins as well, so that obviously adds to. We've yet to have those, but I would say it's just one of the backbones, and it's just a very ubiquitous need for just lending and borrowing. And especially so when you talk about loans that aren't sort of over collateralized. So loans with sort of some sort of trust element, which we don't quite have yet because there's not really DIDs or some sort of identification method where you can sort of gain reputation and sort of not essentially run away with the funds. So that's what I would sort of say. Just quickly summarize the first question. The second question, I think with Cardano, I think it's just sort of a fundamental bet with longevity. So when I look at Cardano, I look at the sort of research-driven approach. I look at sort of the the proper sort of outline of just how do we get scaling going on. I look at the Ouroboros consensus mechanism, the fact that we have liquid staking, the fact that you don't have slashing as a disincentive mechanism, and all these sort of factors adding in. So I just sort of see Cardano, and it's the statement that everyone sort of says, but slow and steady wins the race. And if we're talking about some sort of monetary membrane that's meant to be facilitating a lot of these a lot of global sort of trade between nation states eventually, right, or just very big actors, then you really want to sort of make sure that the tooling behind that, the infrastructure is just robust, and you can't sort of afford to have this move fast, break things sort of approach. I would also add on to that with liquid staking. So that's another thing as well. So as well as Cardano just being generally just a very solid foundation of just really sort of sticking to the ethos of just blockchain, what you want, decentralization, trustless, inclusive accountability, especially with Mithril. I can get into that. That's really fascinating. I would say another aspect as well is that liquid staking mechanism, and that brings up so many interesting things that you can sort of do with that. So, for example, with Yam4, we're using just the liquid stake of the borrower's deposit ADA collateral as payment because it has a pretty good APR of 4 to 5%. And for the sort of like keen-eyed people out there, we actually have on the governance parameters, we have a switch to eventually go on to just a fixed interest rate sort of scheme, repayment scheme. So we still have obviously the core components of the YAM4, like interest just accrues, and you obviously settle this, so it's still keep that mantra of no interest repayments. But yeah, so that's obviously going to kick in when staking rewards sort of become maybe a bit on the lower side, right? It's roughly about 4 to 5% APY, but at the moment though it's quite sustainable, and it looks to be that way for the, I would say, short, medium, possibly long term. It just depends on the parameters and volatility and all that sort of stuff. But yeah, I do apologize if it took a bit longer sort of answering that, but those two aspects I would say would sort of be my answer to that question.
Very interesting, Brandon. Thank you for that answer. Yeah. Welcome, Matt, by the way. So Matt here is from Meld, and thank you for being here. We're just moving into the first questions, but I'll come after Mantis of ADA, and you can do the introductions then. So please, ADA, if you can.
Yeah, so regarding the benefits using Cardano, may I have more expand view on the benefits as well as what the downcomes are, like the pros and cons on Cardano specifically. So the benefit is, and we very strongly built on top of that, is the UTXO model, which basically means someone is taking one UTXO and expanding UTXO, and what one smart contract can see is that one UTXO only. So basically what it means is that an extra safety that we get from the chain level, forgetting about the smart contracts and however the smart contracts are written, the fact that you have UTXO model, and you don't break the rule. For example, like MintSwap example, when they had an issue some time ago, when actually someone could take out the money from the protocol. So basically what they had a NFT that was representing some sort of the right into all UTXOs inside the smart contract. More or less, I don't know exactly how it is, but it's something like that. What we have is actually, we have an NFTs, and those NFTs are representing an UTXO or that specific relationship between the lender and the borrower, or the borrower and the smart contract. And that's it. Like you can hack, in case somehow you hack this, let's say our smart contract, all you can get is you can take that one user's funds. And that's very beneficial for the safety reasons. That's very good from Cardano perspective, and that helps us to be very safe. Those are the benefit using Cardano. Regarding in overall, whether the DeFi and lending and borrowing is going to thrive on Cardano, that's a very hard question, because right now, since we already have an app launched, we have a TVL of maybe 600,000 of ADA or something, we do know why someone should be borrowing assets using our platform. Simply, if you borrow your assets, you can use them to farm, you can use them to short, you can use them for something else, and that's the benefit. It's the risk-free way to use yield farming, and we see that. But the problem is users don't see that. On our site right now, there is maybe 7 loan requests, basically meaning seven people are asking to take a loans and no one is lending them. Since no one is lending them, that's fine. But only 7 people are asking for those loans. So that's the problem that we actually need to solve, and it's very different on the other chains, Ethereum, for example. There is so much on-chain activity, specifically on the DeFi. We don't have this in Cardano yet. We have a swaps. That's cool. We have what else do we have? We have NFTs. Yeah, we have many of those. We have NFTs, but the lending users, we don't have that user base who are using the lending actively. So that's the problem we are seeing, and that's the problem we are trying to solve as well. Did I answer both of the questions?
You absolutely did, Mantis. Royally, in terms of obviously the security that's afforded by the EUTXO model. And I know you guys have got these kind of unique method of using the NFT bonds, right? So you've tied it into that. That's very interesting as well. Can you tell us a little bit about that quickly?
Yeah, sure. So at the very beginning, the idea was we can create some kind of the new financial instrument that would represent the relationships of the loan. And since these NFT bonds, there are 2 reasons of using them. One is the safety that I mentioned previously. The other reason, this NFT bond represents a right to claim some assets from the smart contract. It's very similar to LP tokens that we see on the DEXs. The only difference is this NFT, it represents a unique loan. And this unique loan have two assets locked in, not locked in, but related to. One is collateral and the other one is a loan. Third one is interest, but this one is a smaller one. But this loan and collateral, they have the relationship between it. For example, if the loan is MELD and the collateral is ADA, and those asset prices move in the different directions in terms of one another, this NFT have a price, and this price is fluctuating together with those assets in a different way, different matter, and very interesting matter as well. So those NFTs are tradable. You can actually put them on the sale on the NFT JPEG store, and someone could buy them. And when they are buying it, they have a guarantee, a right to take at least a collateral or receive the loan or whatever the NFT means. So this is a kind of new instrument that we really like. We haven't utilized it that much yet, but that's in the process. That's in the doing yet.
Fantastic. Thank you for that explanation. So I think I briefly introduced Matt from Meld. So welcome here. I'm glad to have you here. So you're going to have to do a few of them together, essentially. Give an introduction to Meld, yourself, and obviously the advantages of being on Cardano and really as opposed to any other platform, or disadvantages as obviously we've also covered here.
Oh, well, then I'll try and run through things pretty quickly. I'm sure some of you have met me or seen me on these spaces before. My name's Matt, work for Meld, do governance, community, and a whole variety of other things, so depending on needs. You guys probably know about Meld too, borrowing and lending protocol, building on Cardano. We're trying to become, our slogan is be your own bank, and we're also trying to not just do crypto to crypto lending, but crypto to fiat by being able to use your collateral for fiat loans. I'm trying to go back to the original genesis of when our engineering team decided they want to work on Cardano. A lot of them had backgrounds that started out in functional programming, so I think it was a familiarity thing with Haskell. But the more they looked into it, not a lot of L1s were trying to build like this robust DeFi ecosystem, but on a UTXO model. And of course, UTXO, with everything sort of being sharded about in different UTXOs, you don't have to worry about global state. And I think that was one of the big appealing things of it too. So we didn't have to worry about the kind of the impediments that you have on an account model. But again, I'm not a blockchain engineer, but that's I think basically the overview of it, why a Cardano seemed initially more appealing, but also too, Cardano, in terms of the blockchain trilemma, Cardano takes decentralization a lot more seriously than other blockchains. And as we've seen with recent events in the past 24 to 48 hours, Solana's price action has been deeply affected by what's been happening in FTT. So when you have VCs owning a large portion of supply and they're forced to liquidate, your portfolio takes a significant hit. So I think one of Cardano's unsung virtues is the fact that it's not a VC coin. And so you don't have that kind of centralization risk, not just in nodes, but also in supply. So I think Cardano does a lot of things right, and sort of strikes that balance on the blockchain trilemma that a lot of other top 10 L1s don't necessarily do.
Yeah, the big fat elephant in the room, we all know. And I suppose this kind of points to really the merits of decentralization when it's done properly. And I'm sure we'll come back to that. But I'm going to pass over to my co-host, Regan, to ask the next question.
Just real quick, I was just wondering, what are some of the risks that each one of your individual platforms that they possess? Like, what's one of y'all's biggest risks? I know that each platform and the way that they operate, they each have their own unique set of risks for the users and for the end client. So if you guys could just go ahead and touch on that, what we'll do is, since Matt, you went last, we'll start off with you, and then we'll jump on over to Mantis and then Yam4 to close us up.
In my mind, since we're trying to do crypto to fiat, the regulatory environment is in flux, especially with what just happened in FTX. So I think things are still going, pretty swimmingly with our acquisition of an EMI license. But at the same time, depending when governments change and legislation change, or you have big events like FTX happening, some legislators, especially ones that are anti-crypto, can move against you and make it difficult to bridge crypto to fiat. So in my personal opinion, I think it's the legislative environment that is the most risk to us trying to deliver crypto to fiat, because there's lots of forces arrayed against us in crypto, as I'm sure you guys know. And so they'll jump at any opportunity to try to stifle innovation in this ecosystem. You just saw Elizabeth Warren, Senator Warren of Massachusetts, yesterday tweeting about, we need more consumer protection on the back of FTX collapsing, even though she'd actually met with Sam Bankman-Fried and his family, which is kind of funny. So I think there's always politicians looking for a scapegoat. So personally, I think it's regulatory and legislative risk.
All right, Mantis, same question. Just for your platform specifically, what would be some of the biggest risks for the end client?
Yeah, so our platform is totally on-chain activity only, so we don't care about the real world. That helps us. But regarding on-chain, our weakest point, the weakest point is the weakest point of the whole whole protocol, and I see it now as our oracle. Because when we launched, we didn't have an on-chain oracle that was representing a price feed that we could use. So we had to invent our own thing, and we have launched our own oracle, basically supplied by 9 nodes. And those 9 nodes are verifying the liquidation transactions only, not all of them, but the liquidations. And that thing is done off-chain, which means we have a distributed participants, like we distributed to 5 different partners, like MintSwap and other pool operators, and they are verifying those transactions, and it's all done off-chain. So if lender is trying to liquidate a borrower's loan, they have actually to ask those oracles whether I can liquidate them or not, and they are deciding this off-chain. So it's not a code base. That's the very ugly thing, but it is the only thing to do the liquidations right now. So the oracles are very important for the lending. And as you mentioned, regarding the FTX and all the thing in the Solana, on Solana, I think there was a Solend, and there is a problem with the oracles, and I think specifically they are making oracles not to be working, simply to avoid the liquidations. So that's how important oracles are, and we don't have that yet on Cardano, at least the ones we could use.
That's perfect. Thank you very much, Mantis. Yam4, same question. For your platform specifically, what are some of your greatest risks towards the end client?
Yeah, so I would say, just apart from just the general sort of smart contract exploit / bug that goes undetected even after auditing, I would say it's just the borrower's exposure to the native governance utility token, CBLP. So just because of the relatively limited use case scenario in comparison to ADA and the just specific nature of it, it's more susceptible to just volatility and just really quite high market swings. Now, obviously, CBLP does have utility in this, in the fact that you have to have it as sort of like this security deposit when you're entering a loan position, and when you exit it, it goes onto the market, which another person, depending on the sort of like depending on the rate, obviously the ADA to CBLP ratio, they'll sort of come in and just sort of pick up where you left off, if you will. So, but it really is just about that fluctuating base, if you will, of what the market sort of deems a fair lending ratio. Between fair ADA to CBLP lending ratio. So I would sort of say it's just literally just it's how much of a percentage that makes up in a borrower's deposited collateral, and also what sort of price, what sort of, I guess, market conditions are they buying it? Are they buying it when the market's rather frothy and things are just generally overvalued, including, just everything and anything? Or are they sort of buying it during sort of a lowish sort of, a sideways market movement sort of moment, if you will? But yeah.
Perfect. Thanks, everyone. I think that you each gave your own unique answers, and I love that, because every platform has their own risks. One platform can be worried about their token, and another one can be worried about something completely separate to that. So thank you guys very much for your answers, and also for your time here today. We have a few more questions.
Yeah, I'll take the next one, essentially. Obviously, we've talked about FTX. We know what's happened in the last 48 hours. It's absolute debacle. SPF comes as a savior of crypto, and suddenly the whole kind of liquidity crunch, and then the whole thing with Binance. And I think Justin Sun's now jumped in, right, to rescue FTX. But, this all begs the question of kind of the decentralization, centralization question. And my question to you as projects is, what are the main advantages of, you could say, like lending protocol, which is completely decentralized, and going to a traditional lender offline? I know it might seem very simple to answer, but give us your take on that. Why would someone come to your protocol and borrow or lend accordingly? You can't lend on a normal, obviously, CeFi, but what is it that would attract someone to come into your protocol as opposed to go to a regular bank or other lending?
Allegedly, why FTX blew up was the fractional lending, fractional reserve lending, which basically means if you have $1,000, you can borrow $10,000 or so. The point of the whole decentralized lending is that based on game theory, you have to be you have to assure that lender all the times will receive the value that they're supposed to receive, as well as the borrower will have all the times the right to take back the, for example, if you're using over collateralized collateral as they want. So that's basically the solution for that, is using over collateralized loans. That's what we are using. So in order to get a loan of $10,000 worth of value, you need to leave, for example, $13,000 or so. This actually, in this mechanism, allows you only to take the loans allows to take the loans only when you have a collateral for it. In other terms, when you have covered the loans, and in case you are liquidated, as a borrower, you receive 13,000. For example, you are liquidated for 10,000, you receive 13,000, and out of those 13, 10 likely is going to the lender. So there is no risk of money being disappeared, or no risk of the cascading liquidations when someone with a little of money is leveraging up into multiple positions and taking much bigger loans than they're supposed to. And that's the way how the smart contracts are built. And one thing is, I think, why the smart contracts are better than people. Smart contracts don't allow to do things that is not written in them. No one can somehow like take the bigger loans than they're supposed to. No one can not pay back the loan when they have to. You can't do the things that you're not supposed to do, and that's the power of the smart contracts. Like if Sam SBF would be using a on-chain or on-chain lending platform, he wouldn't be able to make that much money, as well as he wouldn't be able to make that much of the impact and like all these problems that we have in nowadays. So on-chain lending it's much more safer for all the parties, and also for the ones who are not even related to those relationships. And when someone is lending and impacting your life, that's the ugly part of it.
Very passionate answer. Really enjoyed that. We'll go to Yamfor next. Why would someone come to a kind of decentralized on-chain kind of protocol as opposed to go to your local bank or whatever finance house?
I would say just from the the core pillars really are just not having to deal with KYC or AML. So from an entry standpoint, it's a lot more accessible for a lot of people. And this isn't just necessarily just a statement of saying, just to avoid that because there's something sort of going on in that regard. So this is more of just there's a lot of places with poor infrastructure and just people just don't have access to identity. So it's a lot harder for people to sort of get onboarded into varying financial sort of instruments or things of that nature. So it makes it a lot more accessible from the start. There's a greater level of transparency as well. Ideally, a lot of things should be able to be a lot of assets and just sort of transactions should be able to be checked and confirmed on chain, so in a trustless manner. If I could add Mithril to this as an example, because I really do love that initiative by IOG. Mithril basically is stake-based multi-threshold signature scheme. So that's a fancy way of saying it's essentially a certificate of the state of the blockchain is sort of propagated by stake pool operators in a peer-to-peer fashion, just containing the current state of the blockchain, right? So in a very sort of in a completely third-party-less way, or there's no sort of intermediary party, you can actually check on the state of the chain. So keeping inclusive accountability, that's a huge aspect as well. When it comes to decentralized finance, just the accessibility, the transparency, just the ease as well, the quickness, I should say. So you're on crypto rails, and I think you'll find in the future, if I'm going to go off on a bit of a tangent, in the future you'll have a lot of crypto blockchain sort of based products, and it will just be at the back end, and the average user isn't necessarily going to notice. They just notice that if they enter a financial application, or if they do something, it's authorized. It's authorized. They have the money in their account in a couple of seconds, if you will. So just all those aspects, right? And you've also got the survival of the fittest, if you will, because there's no sort of it's, as mentioned before, it is really rather game theory. There's no kind of Fed or any sort of centralized entity sort of like giving providing a cushion, if you will, of maybe sort of bailing you out. So if the fundamentals of your protocol are flawed, eventually it will die off, and of course people lose money, and of course people get hurt. But ultimately speaking, you really sort of end up at the end of the rainbow, so to speak, with the best products that make sense from an economical standpoint as well. Just quickly with YAM for if you with YAM for a reason to specifically come and take out a loan through YAM for CBLP lending protocol is just the passive nature of it. So if you take out a loan through YAM for you do, and obviously I've mentioned the risk before, so it's obviously not risk free. Just to sort of reiterate that there, but you do sort of have this passive exposure to ADA, where you don't have to worry about interest payments or and an indefinite loan term, as well as no liquidation risk and no margin calls. So it's truly a passive set and forget affair. Not to mention the secondary facts of what you could use with the NFT deed, since your position is represented as an NFT. So it's very similar to like an LP token that you would get from providing liquidity to a decentralized exchange. You can do a lot of things with that NFT deed. You can trade it on a NFT marketplace like JPEG Store, or you can even extract further liquidity from it by borrowing against that position. So you can take a loan against your loan, if you will. Of course, that comes with its caveats, such as obviously now you're introducing most likely margin calls and just it's a shorter time period. Yeah.
Very interesting answers, and yeah, thank you for that. Yeah, I mean, interestless loans are, I'm sure, very attractive, but let's go to Matt as well, and then we'll round it off there.
My co-speakers here have definitely covered a lot of it. I mean, I think what we've seen, I'll just use like real world examples that we've seen over the past, like with FTX and in the summer too, with Celsius and Voyager, like basically going under, is that one of the things we originally wrote in our white paper, one of the biggest selling points of DeFi here is there's no custodial risk, insofar as like there's no like human beings like doing funny business with your money. Now, depending on how you define custodial risk, you could say like errors in the code are custodial risk in that they're technical, but that's more of like a definitional semantic issue. But fundamentally, there isn't any custodial risk when you have the immutability of the code, as Mantis was saying, right? It's all determined by hard logic of the code, and it can't, is like, at least errors or vulnerabilities aside, the logic is supposed to work the way it's supposed to work, right? And so you don't have to worry about custodial risks like people like Sam Bankman-Fried going and lending a ton of your deposits to his personal fund to go and short everybody else and then eat crap when the market moves against when all your liabilities are basically, or all your collaterals based in a liquid FTT. And then we saw with Celsius, people were calling it derisively CDeFi, like CEDEFI, which really just centralized. They're going around and using everybody's deposits to degen on existing DeFi protocols, and it was just recreating the previous risks we had with everybody else's fund. Like so much of like DeFi right now is really like centralized. It's not DeFi at all. It's just a bunch of middlemen going around and YOLOing people's funds and doing it poorly. And so we seem to just, for the sake of user experience, people are willing to take on a lot of custodial risk. And so the market is teaching users hard lessons about custodial risk over and over. It's bad in the short term, but in the long term, I think it's great for those of us building decentralized protocols, because now we have like these yardsticks, these reminders, these train wrecks reminding everybody, hey, this is actually a thing that could happen to you, right? So I think the market has proven that sticking to the philosophy of crypto and decentralization is the way to go. And so I think that's just the biggest thing overall, because Aave's still here and it's fine. Compound is still here and it's fine. Curve is still here and it's fine. I mean, not everybody's had to bump like a sweet ride. Bancor had to like pause rewards on their system because they ended up having to print too much or distribute too much of their own token to shore up a global shortfall. So it's not to say like decentralized protocols don't have their own risks as well, but it seems it's very telling that all the decentralized protocols, especially ones that everybody else is holding coins on, like Alameda, are still here and they're still doing fine because everything's over collateralized anyway. So at least in an anonymized system where you have to, right, where you don't really need to KYC or AML the end user, right? So, and like, yeah, as Amber was saying too, you can use it to take out these loans to do some leveraging or degenning or whatever you want. Of course, the market could always move against you, but again, like if you're taking out, you have that ability to take out loans denominated in something other than your collateral. So you always have that kind of risk when you're holding the asset. But I mean, you could do a lot of cool things with it too. So just to like, kind of like reiterate what my co-speakers are saying here, I think the immutability of code, and two, like the philosophy of decentralization and basically removing custodial risk. No middleman. It's just you and the end user, like it's you and the counterparty, with just code acting as a quasi intermediary. I think that's really the way to go.
I would add that maybe we didn't touch on is low fees. You know, I mean, you got all these middlemen in CeFi that take big cuts of your, you know, whatever it is that you're taking out, a loan mortgage or whatever it is. And then the other really great, exciting thing is that it's opened up. You know, we got how many 2.3 billion people who are unbanked. You know, they can actually participate in the financial system where they're not excluded because they don't have a driving license or they don't have a residential address, which might sound really kind of odd to us who might live in countries that we have all of these things, but there are still many, many people that are excluded from this overpriced, if you like, CeFi. So great to see projects like yourselves and the whole DeFi space kind of coming on top. And unfortunately, we all do take a hit after debacles like FTX, but when you know people really kind of dig deeper, they can see that, well, these are really centralized entities that have one single point of failure. I mean, in this case, it was one guy, right? So he's kind of messed up the whole system for us. On that, Regan.
Well, first off, I want to touch back on a couple of the things that were mentioned previously on your question there. And I just wanted to point out that we're also allowing people to be their own bank. And part of being your own bank is also lending out funds. And so you can either put your money in a bank and your bank is going to lend out money for you and they're going to profit from it, or you can assume some risk and you can lend out your money and you can profit from it. And so I think that that's really the key of crypto. And so whenever we look at lending platforms, we really need to understand that, yes, it comes with some risks. Yes, it comes with some additional exposure to markets. However, we can look at those markets, and what we can do in the crypto space is we can undercut their local banks, especially in third world countries that don't have proper identification. We can actually charge less than their banks, and we can profit still at a higher margin than just general staking. And if it's done correctly, I think some platforms might be able to do staking as well as lending. But with all of those incredible things said, I think that I want to go back to what Mantis said earlier, and he said he had one of the biggest problems was getting borrowers, and so then that leads to mass adoption. What are some of the major challenges that you've seen for mass adoption?
What we are hearing from people, they are saying that we are the lenders. We simply want to put our money in some sort of a smart contract, and we want to receive stable returns, like 5%, 10% of those assets or whatever it is. They just simply don't want to do the things. They are lazy, like every one of us are lazy. So that's what people are wanting. They simply want to put it into smart contract and receive yields from there. But the problem is, who are paying those yields? If there is no borrowers, they are not paying the yields. But if we would have Aave running on Cardano, something like Aave running on Cardano, and no one is borrowing, those yields of your deposited assets are going to be close to zero. You would basically make no money out of it. So I think that to have a mass adoption, we have to have the use cases to borrow assets. For us, even though we are kind of in our platform, lenders are more or less, they are hurt by the platform simply because, for example, if someone is repaying the loan quickly enough, they are paying very low interest for that loan because it's based on the time, and it's hurting lenders. And we thought that maybe not so much of the lenders, we would have not so much of the lenders, but the problem is the borrowers. No one is, not the no one, but very few of people do know why to borrow. And that's the problem. I suppose if we would have much bigger activities on chain on Cardano, if we would have different yield farms, different apps, I don't know, what is offering yields or whatever is doing something. Even, for example, if there is a drop-off for liquid users or liquid holders, someone could actually take the loan of those LQ tokens and have in the wallet to receive the airdrop. as a basic example, but not so many people are doing it. I suppose maybe not taking the loan is something that takes that requires a lot of mental power to do, as well as it involves risks, and people don't like to have risks, especially on the blockchain. So generally, I don't have an exact answer why we don't have a mass adoptions. I don't think the lending is the starting point. I think the lending is the middleman between everything else on the DeFi. We should have something that would encourage users to borrow funds. Then we will have a borrowers, and because we have a borrowers, we will have a yields, and because we have yields, we will have a lenders, and we all will be happy then. But we don't have the reason to. We don't have so many reasons to borrow, and for those we do have, very few of people do know why to do so. So that struggles us.
No, I think that's a fantastic point. I mean, I know looking at it from my perspective, I think the main reason for me to be a borrower would be tax advantages, because if you are borrowing against your asset, then you're not taxed on that asset because you're taking out debt. And at least in the US, you're not taxed on your debt.
Yeah, one thing I forgot to mention is the trading activities. That is more advanced as well. For example, the shorting and leveraging, you can actually do with the lending, and you cannot do without lending. And shorting, I think shorting is very essential for every market. In case some sort of the token is, for example, rising without a reason, and the real value is not that high, there should be some market participants who will actually short the token in order to bring price down when it goes up. But after all, when the price, for example, it collapses, it goes down a lot, those shorters, they will have to repurchase the same token and put the price up again. So those shorters, they're important market participants, and I suppose we should have more of them.
Well, yeah, one of the biggest, I think, use cases, of course, like you said, like you don't have to, even if in an over collateralized system, you basically have the capital in hand. But of course, if you want to take out some of that crypto and use it in like the real world, quote unquote, of course, that means converted to fiat. The moment you do, you have a capital gains event or a capital loss. But yeah, just staying long in your crypto and being able to take out loans against the assets means you don't have to trigger capital gains, right? So it's more tax efficient if you just want like a very simple tax year, right? You can just take out loans against the value of those assets. Mind you, of course, they're crypto, so they're more volatile than say doing a traditional one. That's just against fiat to fiat, right? But I think like the interesting thing about DeFi though is that interest rates are determined by utilization rates, right? And so you don't have to worry about a central bank trying to have like political considerations for why the interest rate is where it is, among other things, and inflation and whatnot, right? So it's really just determined by the interplay between the amount of borrowers and lenders in the system. I mean, for the lenders right now, the problem is that, right, you can get like a risk-free rate of return with the Treasury, or the U.S. Treasury, with much like a better deal than maybe you can in other protocols, right? But for the borrowers, though, it's great because if interest rates are going up and there's enough lenders out there who would rather just lend on chain instead of lending out to get T-bills or something like that. For borrowers in crypto, they can get something that's below. They can conceivably, I should say, get something below the Fed rate or whatever, or like the bank rate. But again, that begs the question: why would then lenders just want to go on the protocol when they could get a risk-free rate of return that's higher somewhere else? Now that starts to bring in the question of also incentivization by the protocol, right? Because there's things like fees when people take out loans and stuff like that go back into the treasury and then get paid out to lenders as well, right? And so you can use that, turn it back around, stake in. So there's more mechanisms that I think that these protocols have to incentivize lenders beyond the utilization, beyond the interest rate that's just generated by the interplay, like the amount of liquidity to borrower interest, right? So again, if you just got way too many lenders, obviously they're going to crowd out the system and drive interest rates down. But if you have other things on the protocol that you can quickly implement that can incentivize them and increase their yields, not just beyond like the straight interest rate on the sticker there, I think you can attract more lenders, right? And so I think in these, like, because past, God knows, like ever since the financial crisis, like what now, 15 years ago, like, and also the European, like the Greek debt crisis in like 2011, like, interest rates were low and they've been low for a long time. I don't think they've ever been this low for a sustained period ever, right? Or at least not in a very long time. Like in the 80s, we had like Paul Volcker like cranking up interest rates to 18, 19%. But for borrowers looking for credit, in a system where credit's starting to become expensive, now DeFi might be the solution for a lot of people looking for credit, looking to build in a system that otherwise has tight credit, where it's difficult to find somewhere, it's difficult to build, right? So as long as the protocols can do more things to incentivize lenders, I think we could sort of strike that milieu.
No, I think that you hit on a great point there of how DeFi can actually incentivize clients to either be a lender on your platform, or you can then borrow against other people's stuff. But you can do more things than just lend or borrow. You can also collateralize other assets than just physical assets. You can also collateralize digital art or digital collectibles or what have you. And we're going into an era where anything that can have value will have value. And so, especially digital, imagine trying to be able to collateralize against your gaming account. You can't do that right now. And I don't think that a bank would ever actually do that. But through NFTs, through once we actually start to get interoperable with all the other platforms and things, I think that is something that would actually have value, because you've spent hours and hours and hours building up that account and you don't want to lose it. So just something as crazy as that, or even something as crazy as an NFT, I think that DeFi can actually lend out against a lot of things that traditional banks can't. And I think that was a great point there, Matt. Yam4, same question for you on challenges of mass adoption.
Yeah, I was just sort of thinking through, and I think it just I can summarize as just a lot of the tools that we have in DeFi, a lot of just the products, like when it comes to from synthetics to exchanges to just lending and borrowing protocols, they're really sort of tailored for just the trade fi almost, or just a person that's very sort of like adept at sort of like risk management. Because if you just take lending and borrowing, it's a very sort of hard deal for the average person coming in. You sort of have to explain to them, like, okay, when you have this collateralized debt position, right, and you have a loan open with let's say Aave or Compound or whatever it is, you have these fluctuating interest rates that you have to sort of deal with, and that's based on utility, right? So when times are really quite good, you obviously have a demand on the borrowing side because everyone wants to sort of utilize that to gain more exposure because things are going up and up. And you also have to deal with liquidity risk and margin calls, and that's already a risky enough sort of aspect when it comes to traditional stocks. Like even if you're dealing with like index funds that have been generally sort of trending upwards over the decades, such as the S&P 500 or like a Nasdaq or a Dow Jones, it's still quite a risky thing. And you're talking about sort of adding margin calls and liquidity risk, liquidation risk to crypto, which is quite volatile, which is very as we all know. So it's quite a hard pill to swallow. It can be done obviously, and some people do it very very well, but it's just kind of it's a very steep learning curve for the average person sort of getting in. So I think we'll probably see mass adoption when you have these sort of financial products and applications that really sort of cater to the average person, right? Whether that has to come through the use of DIDs, so you can actually have loans that actually that you don't have to have over collateralized positions with, and you can have this sort of trust element, and that's going to be very interesting because all of a sudden you have this sort of like global lending market open to you, right? If you have this sort of universal DID, if you will, or some sort of identity mechanism that you can sort of take out a loan from a protocol made in Malaysia, or a loan from a protocol made in Brazil, or XYZ. So you can really sort of enter this global marketplace where the best product sort of is what garners the most use and utility. But I would sort of just say, just when it comes to just the products and the applications being built at the moment in DeFi, it's very much centered towards the more experienced sort of person, and less for the average sort of individual that's sort of just maybe looking for just a passive set and forget sort of affair. So that's what I would say is one of the very big aspects of just blocking mainstream adoption, right? It's very hard to I tried to explain to my mom what was going on, just as an example in regards to the Kongs of how you have to buy a Kong and then you have to stake a frame, and it gets quite elusive. But yeah.
Yeah, I've dug into the Kongs as well, and I was like, "What in the world?" So you buy this, you stake that.
Yeah, it's crazy.
Yeah. So I mean, if I'm hearing everybody correctly, I think that there's three key aspects that we can really simplify all this down to, and that's education, ease of use for the end consumer, and then reputation, like building up that trust. I think that that's about what everybody said. Did I hear you guys correctly?
Yeah, I would agree with that.
Even though if you are borrowing long enough, at the end you have a DID which represents you as a reliable borrower, and that's your collateral. That's your collateral that you use to take the loan. It sounds interesting.
Great answers from everyone as usual. I know, Matt, you've got a pressing engagement. You had said before, may have to leave soon. So please feel free whenever you have to leave. And thank you for your participation. We haven't got long to go. And really, it's about regulation, something we don't necessarily want to talk about. DeFi.
That's something I would have loved talking about. But yeah, I have another meeting scheduled in 2 minutes. So, but it's been fun. And thanks for hosting this. And thanks, also to Yam4 and Mantis too. I mean, I think it's good seeing that we're all pretty much on the same page about I think where DeFi is going and borrowing and lending. And yeah, I'd love to talk more about the political environment, especially. I can go on for that for hours, but sadly, I got more meetings lined up for today. So
fantastic, great to have you again, Matt, and best of luck and see you soon.
Yep. Thank you, Matt.
Thanks, guys.
So I suppose this I'm pointing at Yam4 and Arda. Really, from a regulatory perspective, it's something that is inevitable. We all know that. For whatever reason, I don't want to get into too political about this, but it's coming. Advantages, disadvantages, and realistically, where's it going to go, and how is it going to affect your industry and DeFi as a whole?
So regulation is a really interesting one because there's multiple ways of looking at it. I would just sort of say the world generally sort of takes after what the United States does. So they tend to set the trend, if you will. And with a lot of the issues that have currently sort of just in this year alone, I mean, we're talking Celsius, Voyager, recently FTX, and a lot of just these examples that of just these systematic failures with what a lot of people sort of considered these good sort of crypto-based infrastructure. It really is painting a really quite bad picture in regards to the eyes of the regulators and just the average person. So I do sort of fear that there will be sort of an overcorrection, if you will, with a lot of these aspects. But crypto is one of those things that it's quite resilient if you do it right. So in the case of Cardano, it truly is a global protocol. So if the United States takes, or any country for that matter, takes a rather draconian sort of viewpoint, it's it's quite detrimental to innovation or any sort of progression happening in that in the blockchain sector in their jurisdiction. So it will just go elsewhere because crypto in this case is really the internet. It's really the native currency of the internet. This isn't to say that there should be no regulations. I do think consumer protection is really quite important. I do think there should be some sort of regulatory framework put in place, and just really quite basic, just sanity checks. Like, do you have the assets that you're saying that you have when users deposit the funds? Can you show a proof of fund, right? Can you show us where they are? Like the on-chain aspect, etc. So I do think regulation it's coming. It's here already, and I sort of do hope that it might just be a bit of a tug of war sort of thing. I do hope eventually saner minds sort of prevail, but I do think we'll sort of you'll see a lot of scrutiny with stable coins. And sort of just these custodian sort of entities, such as CeFi, if you will, before that goes into the DeFi realm. But for better or for worse, though, regulations here. It's here. It's here to stay, obviously. And in the long term, it's a good thing because it does eventually onboard a lot of Fortune 500 companies and a lot of just other nation states, and it gives legitimacy to the space. So yeah, it's just a matter of how much of an overcorrection it is based on what's happened, and I think unfortunately that might be more than it deserves. But yeah, those are my general points on that.
Yeah, great points. I mean, there's some good to it as well. As we know, perhaps it's the CeFi kind of army trying to also get their cut, so hence they're lobbying and trying to over-regulate, perhaps. But there are good points to regulation, as you pointed out, consumer protection, stopping bad actors, etc., which are really, really good points. Mantis, what's your perspective on this?
Honestly, I think we are in war with the regulators. That's the reason why the Bitcoin electronic cash system was written, the white paper in 2009. Those people who are regulating, they have their own incentives, they have their own families to feed, they have their own relationships and their own money, and they want to make sure that the system that they have built and built reasonably, like all the rules, everything that was used, like for us people, it's there with a reason. And sometimes it goes to the right side, sometimes it goes to the bad side. But what we have right now, it's something very weird. And from the simple view of history of money, the money should be something free, and it shouldn't be something regulated by someone. For example, like I'm from Lithuania, and we are very close to Ukraine. We almost all the Lithuanians are on the war side with the Ukraine. But the thing is, with the global trade, we have a global trade, and the Russia is the biggest supply with the oil as well as the gas for us Europeans. And the thing is, for example, right now I think Russia is outside of the SEPA, which means they cannot make the transactions in dollars or euros or whatever. So that's the good part for Ukraine. That's the good part for the politicians, but that's the bad for the people. And in the bad for the people in that terms, from the point of view of the freedom that we don't have. When world cannot trade, you cannot make things efficiently. You cannot make things that you're supposed to make. So I think that's why I don't really support the regulations. I know it sounds bad. And regarding from the point of view of our protocol, we built the code, we compiled smart contracts, and we made the transactions. Now anyone can make the same transactions in our protocol. They don't need us. We are helping them with our site. We have our own APIs. We help them to make those transactions to serialize them. But the point is, anyone can do that on Cardano blockchain. So the regulators cannot likely they can come to us. We also Cardano Cash thing, Tornado Cash thing. When simply they announce that people are terrorists, the Cardano Tornado Cash is terrorist. Sorry. So the point is, this code is decentralized. This code is running on the blockchain. Anyone going to Cardano scan can see there is a smart contract, and they can use this smart contract. They don't need us. So the regulators are not a threat. I would say they are a threat. Like they could shut us down. They could put us into jail, but the code will be there. So that's a very important thing of the blockchain itself. The point is that there is no third party. There is no someone who can shut you down. This is good and bad. This is bad when you are actually doing something beneficial. When you actually have the code that is public and you're allowing users to use the platform in the way they're supposed to use. And if your code is written bad or your code is doing something bad intentionally, then yes, then regulator will try to shut you down. But they can't. You can't turn down Tornado Cash once again, right? So that's a very important thing. Is it's more of the wealth distribution. Those people who are rich right now, they are rich because they've been using this monetary system as they've been using it. And right now there is a new money. There's a Bitcoin, there is Ethereum, Cardano, and so on and so on. And it's a different system. And likely there is going to be a huge wealth distribution in the future if we fight. If we don't, we simply just bend our knees to our current system. And that's why we are here. That's why I am here, simply to make the change. And I suppose to make the right change.
I love your passionate answer, and I'm very much with you on many of the points. I mean, you pointed out to the original paper, that was obviously devised. And really, why was it devised? It was devised because the 2008 crash and all of these regulated big institutions that were obviously in with the regulators in many ways took a lot of people's money. And through that kind of, if you like, those ashes, the phoenix of Bitcoin arose and the crypto industry arose. So I'm totally with you in terms of regulations are hopefully one day they won't be necessary. But I think there are enough bad actors though out there. We all know the ICO case, how many people kind of got ripped off. No, nothing. Less of kind of what the projects that are with good intentions. But unfortunately, there are bad actors out there. But the code doesn't lie. And I see Yamfus, you got your hand up, so please go ahead.
Yeah, I just wanted to quickly just add one more thing onto the regulation bit. It's just I think the best way moving forward really is just through incentives, right? Because you can never really, as was said before, you really can't really ban a properly decentralized application. It's on this immutable ledger that's just, obviously distributed and properly decentralized around the globe. So what you should ideally do is sort of have this sort of mechanism, or sort of where you have these where you just have these incentive mechanisms, right? Where you kind of say, okay, to the DeFi, the decentralized applications that have maybe a visible list of developers, doxed in other words, or the code is like clearly open sourced, and the economical model is clearly laid out, and it's sustainable. Like will give you just easier access, or will present it, if you will, to these certain channels, or whatever have you, or like it's more easily accessible towards like American citizens, right? They can sort of they have this sort of they have this certification sort of system, or it's kind of something similar along the lines of just I would say what IOG is trying to do with the Lace wallet, where you have these sort of certified dApps in the dApp store, if they sort of reach certain criteria, but it's still open towards anyone, and it's just an incentive, because you really want to sort of reach those certifications to get a bigger user base, which, means more monetary value created or traded on your platform, whatever it is. So I think that's probably the best way to go about it. Just incentives. Incentives are always better than just outright banning something. But yeah, I'll leave it. I think Sean's also got his hand up. I'll just yeah, that's all I want to say.
Actually, just wanted to add on to that some things that, personally, I wholeheartedly agree with Mantas, if I'm pronouncing that right, that regulation is kind of trying to turn crypto into TradFi. So, like, we always have to be a little skeptical of the suggestions that regulators have, because often, like, what it amounts to is censorship and like lack of financial freedom and accountability for many actors. So, like, regulating front ends of apps, all of these seemingly reasonable things are actually pretty devious, I think. So, like, even while Brandon and I have talked about how we want to implement YAM4, essentially the idea is that everything lives on the base layer on Cardano mainnet, such that anyone who has access to a full node and Cardano CLI can interact with YAM4 without needing permission from, well, the team or anyone really. So it's like one of our design goals to be as censorship resistant and resistant to single points of failure as possible.
Perfect. Given where you guys view regulation and where you guys think that we're going based off that regulation, I mean, number one, I think that there will be some regulation from the U.S. I mean, we saw it with the internet. However, now we get freedom of information, and it was light-handed regulation. I'm hoping and I'm hopeful that we get the exact same thing here. So even in the .com bubble, they didn't come down with heavy-handed regulation. Now, this being money, they might do a little bit heavier hand. I hope not. But where you see regulation in this space will really that'll really affect the future of this space. So, given that now we've got the regulation question out of the way, how do you see the space developing in the next few years, specifically of DeFi?
That's probably the least knowledgeable topic to me, and I could only express my hopes. I do hope for those who want to regulate, they will need to spend much more money to do so than they can. It's very hard to it's easy to regulate CeFi. It's easy to regulate SBF. It's easy to regulate Binance. It's easy to buy IPs and so on and so on. But it's much harder for the on-chain activity, and that's what something people don't always separate. So that CeFi with all the taxes and people who manage the funds is a different from the DeFi. I suppose the CeFi definitely is going to be regulated after these events of the last few days, but it's going to be close to impossible to regulate the DeFi first because it's very hard. It's very hard to regulate distributed ledger. Of course, we can see this on the Ethereum blockchain right now with the OFAC regulated blocks or whatever the chart represents. Right? It's possible, but it's I think it's very hard thing, hard decision to make as politician because it's very weird when someone is banning a program. Someone is saying this program, for example, is a terrorist and it does harm our country, because people will start to ask why and how and what it is actually hurting. So this is very expensive decision to make to politicians. So it's very hard to ban DeFi, but CeFi must be regulated because if I have my funds in any of the exchange, I don't want someone else to lend it out to someone else. Right? It's very essential. I just want to withdraw the funds every time I can withdraw it. But I want to withdraw it. Right? So it should be CeFi should be regulated. DeFi it should be impossible to regulate. I hope.
And I think that you definitely hit on the core of DeFi. And in order to not regulate DeFi, I believe that DeFi should be open sourced. It should be externally audited. There should be maybe DeFi labs that build out the actual DeFi platforms, but there should be no central custodian of anything like any sort of trading or lending platform. There should be no single custodian. So then that way, if any one regulation does come down on it, then we at least have the other entities to continue on their efforts. But Yam4, same question to you. Where do you see the DeFi space going here in the future?
I've thought about it for a while, and it really is just these sort of like, to me at least, these two sort of these two very different sort of like forks in the road, right? You have this sort of amazing sort of future where you actually have these, you have multiple blockchains because you have multiple blockchains operating that are truly decentralized and distributed. You have a proper individual inclusive accountability. They have all the mantra of decentralization of heart. Think Cardano basically what Cardano really is, and you have them facilitating these sort of trustless transactions and just economical activity behind just nation states and just all these sort of aspects, and that's fantastic. And on the opposite side of that is just the trade fi. Really, like you have basically just these very permissioned, very heavily sort of regulated sort of sphere, and just very centralized blockchains where it's really no different from it's banking 2.0, really. So it really could go either way. And I look at the market and I sort of look at the things we're up against, and it's quite shocking to me knowing how much I do that the top one. If you look through the top 100 coins by market capitalization, which isn't really which can always be sort of gamed right through various methods, you'll find that there's starkingly just a few contenders where they really have a chance at actually sort of they're vying for that sort of that mantle of actually trying to be this proper economical layer, right? That you can actually this proper decentralized blockchain, and a lot of them are just sort of these venture capitalist or these sort of these move fast and break things sort of like chains, or just chains that they mean well but they really are going on this really weird path, if you will. So it's very, yeah, I really can't say if I do know. So it's really one of those two, and you know it's never really it's it really is quite disheartening, especially after this year as well, when you see the systematic failures of things such as Celsius or Voyager, and you see the risks of custodial funds, custodial your funds being held in a custodial manner. And you have people, and FTX was quite shocking, of course, but there is that mantra of not your keys, not your coin, and you have people sort of learning the same lessons over and over again, and and it's it'll be a couple of years, I think, maybe 2 or 3 or 4. Everyone's sort of forgotten about these systematic risks if we, assuming we don't get proper regulation, or there's oversight or etc. And we sort of go through the same sort of tumbles. We have this another Mount Gox, so to speak. But obviously, this is a lot worse. This year has been a lot worse than that. But yeah, I guess to summarize, though, it can really sort of go to one of two ways: banking 2.0, or this sort of very bliss, properly decentralized future where it's really transparent and people can just access these financial tools and applications, and there's no discrimination happening there, and you really sort of have the vision that I believe Satoshi really wanted. So it really sort of depends what the market decides, and the market at the moment is just very unreasonable, so to speak. It's hard to build, and what people don't realize as well is it's hard to build these things, right? Like, you've got the blockchain trilemma, which is just the classical between scaling, security, and throughput/speed. And in a lot of cases, it's really just sort of these trade-offs that you have while trying to balance these aspects. And it's always easier to just sort of like have just a handful of validators crank the throughput up, have obviously the node requirements very high to sort of facilitate that, and just call it a day and say, oh, we have 1,000 TPS, right? Which is not even a very ideal sort of way of measuring, because Cardano can have transactions within transactions, so that's not really an ideal method of, you can have one transaction containing multiple UTXOs setting multiple assets in one go. So it's really yeah. So that's what I would say. I don't know. We can either be in heaven or we can be in hell, and I'll say that. I hope we're in heaven. I like heaven, but yeah.
Yeah, I think that's a. I think that's an interesting take on that. There could be this bifurcation of markets, and I think that we're there already, but it's just not to scale. And whenever we're talking about transactions per second or whatever, yeah, that's not a good way of measuring things. But yeah, as far as in the future, I think that you're right in the fact that we are going to have two separate markets, and that we can start to either blend those, or it's going to be two hard different markets. And then it's just going to be up to the market to decide, or the people to decide where they want to do business at.
Yeah, great insights there. Let's move to some questions from the audience. I know, Chucky, you've been here for a while, so you're a speaker now. So do you want to go first?
My question is, whatever is going on in the crypto world since 2-3 days regarding Binance, FTX, do you think people will still trust the Launchpad exchange, DeFi ecosystem, NFT project? How will you give long-term assurance to support and attract people to your ecosystem even after that?
You should trust it more now than you could trust it previously. Since some of the bad actors are out, so it should be the safer place. Other than that, we don't know. You can't know that. Like, you really can't know. It's a tax. It's a centralized finance. You can hope, and we are very early.
Absolutely, I would definitely add to that as well. What Mantis said. I think the trust in DeFi and the real decentralized sort of protocols should be increased. And when when the masses look at what happened and they realize that these are centralized entities and these are the problems that obviously come off of that, hopefully the trust in the DeFi world should increase realistically. Absolutely. Thank you, Chucky, for that question.
I have one more question, if you give permission, I ask.
Sure, yeah.
Marketing power plays a huge role in opening any project. So my question, do you have adequate marketing power and capital to push this project to the top project? Because without proper marketing and capital infusion, project failed. How do you convince us you have adequate marketing power in the crypto field?
Marketing certainly helps. But I find I sort of like to stick to, and I can't remember who said this exactly, but I'll sort of quote it. I think marketing is generally the price you pay for a mediocre product. So if you're really bringing something to the table, such as Liquid or Indigo or these other fantastic protocols building on Cardano, generally speaking, the product will speak for itself, and you'll just garner the attention and the reputation from just word of mouth and the utility and use case. Marketing does definitely help to accelerate things, to definitely get you over the line, so to speak. But I generally sort of find that if you just sort of build and you trust in the process, you should generally be fine. I mean, just to give an idea with the Ample, right? It's not really there's no one else doing crypto-backed loans with no liquidation risk, no margin calls, no interest repayments, and indefinite loan terms with the NFT deed that's also tradable, and also you can use that as a collateral to leverage against to extract more liquidity. So I would say in this case, in Yamful's case, the product really speaks for itself. But that's not to say marketing isn't important, but it just really sort of, I think, depends for a case by case basis.
Great, thank you, Brandon, for that. And we go to Osmium.
Yeah, hello guys. I got a question for Yam4. I'm very excited with what you guys are doing. Very small team, but very ambitious, and I like the project. So, just a little simple question: are we expecting testnet this year, December, right?
Yes, sir. That's what we're trying for. We leave no promises though, because I mean, just it's development, so things get pushed back, or we might not be happy with the sort of quality of things, right? So we've just sort of always like left that small disclaimer on just the roadmap of everything's subject to change, but that's what we're aiming for. Yes.
Okay, thank you, man. Thanks.
Just a quick point here. I'd like to say that number one, thank you to both the speakers. I don't know if we're going to get another Q&A or not, but thank you both to the speakers who took their time out of their day. You guys are both building projects. You're both working really hard. You have your teams, and you have a lot to manage. So I just wanted to say thank you to both of you for taking our questions and for reaching out to the community and to really try and provide a transparent path for where you're at and where you're going and just mainly what you guys believe in. And I think that this is a great conversation today.
Absolutely, Matt. And I'd like to thank all three projects, Ada, and Meld. Thank you very much for taking the time to come and share your thoughts and your projects with the whole community. And also I'd like to thank my co-host, Reagan, as well. Thank you for co-hosting with me, to making this another great spaces, informative, insightful, about lending and borrowing protocols on Cardano. I'd like to thank you all and call it a wrap. Good night.